Hey traders, in this video I'm going to reveal a liquidity sweep strategy that works on all time frames and follows the principles of smart money trading. This is the strategy that can take your trading to the next level by aligning you with the moves of the biggest players in the market. Here's what you'll learn: how market makers trap you. You'll uncover their strategies and learn how to avoid falling into their traps. The market maker model. You'll understand how they act and how to spot their moves before they even happen. How to identify liquidity sweeps. You'll learn to recognize market maker liquidity sweeps and how to check if they're real or fake. Real chart examples. You'll see the strategy in action, step by step, from analysis to profit. This strategy works for scalping, day trading, and swing trading. It's also effective across various markets, including forex, crypto, stocks, commodities, and futures. With that being said, let's get started. Market makers know how you trade. They understand the patterns you trust, and the double top is a perfect example. Price hits a resistance level twice, struggles to break higher, and starts reversing. You think, this is it, a clear signal to sell. Convinced, you enter a short position and place your stop loss just above the resistance level. But here's what's really happening. Market makers are deliberately letting the resistance level hold just long enough to attract sellers like you. They know exactly where your stop losses are, clustered just above the double top. When enough traders have entered, the price suddenly surges upward, breaking through the resistance. This isn't a breakout, it's a liquidity sweep. Market makers trigger stop losses to create the liquidity they need to fill their own sell orders at higher prices. Once they've collected liquidity, the price reverses sharply and drops in the direction you originally expected. But now, you're out of the trade, watching the market move without you. The double bottom is a pattern most retail traders trust. It looks like a strong foundation for price to bounce higher. When the price tests a support level twice, you think, this is solid support. It's time to buy. You enter a long trade and place your stop loss just below the support level, confident it won't be broken. But here's the reality. Market makers know this is a popular pattern among retail traders. They allow the support level to hold just long enough to attract buyers and cluster stop losses below the double bottom, creating a liquidity pool. When the time is right, the price dips below the support level, triggering your stop loss and causing panic selling. However, this isn't a real breakout. Market makers use the liquidity from your stop losses to buy at a discount and fill their orders. Once they've collected enough liquidity, the price reverses sharply and moves higher, leaving you out of the trade and wondering what went wrong, even though you followed the pattern perfectly. Trend lines are a go-to tool for many traders to identify market direction and plan entries. They appear clean, logical, and reliable. But here's the truth. Market makers know how you use them, and they use that knowledge to trap you. You see the price respecting a trend line, touching it multiple times. With each touch, your confidence grows, and you decide, if the price touches the trend line again, I'll enter. As the price approaches the trend line, you place your trade and set your stop loss just beyond it, thinking it's a safe spot. But here's the issue. You're not alone. Many traders are using the same trend line, placing their stop losses just beyond it. Market makers recognize this predictable behavior and see an opportunity to create a liquidity pool. Instead of bouncing as expected, the price breaks through the trend line. Your stop loss is triggered, and you think, it's a trend line break, I was wrong. But this isn't a genuine break. It's a liquidity grab. Market makers use the liquidity from triggered stops to fill their own positions. Once they've collected enough liquidity, the price reverses and resumes the trend you originally anticipated. But now you're out of the trade, and the market makers have taken control. Now let me show you exactly how market makers use support and resistance levels to trap retail traders and take their money. You spot a support level where the price has bounced several times. It looks reliable, so you think, this level has held before, it's safe to buy here. As the price approaches the support again, you place your trade and set your stop loss just below the level, confident it's protected. But here's what really happens. Market makers see your support level as an opportunity. They know retail traders cluster their stop losses just below it, creating a liquidity pool. The price suddenly breaks below the support level, triggering your stop loss. You assume the support has failed and the market is breaking down. But in reality, it's a liquidity grab. Market makers use the liquidity from your stop losses to buy at a discount and fill their positions. Then the price reverses sharply and moves higher, just as you originally expected, but now you're out of the trade and the market makers have capitalized on your loss. Now let's look at resistance. You spot a level where the price struggles to break above, and it looks strong. You think, this is the perfect spot to sell. You enter a short trade and place your stop loss just above the resistance level, expecting it to hold. But just like with support, market makers use this resistance level to their advantage. They know sellers are clustering their stop losses just above the level, creating another liquidity pool. The price suddenly spikes above the resistance, triggering your stop loss. You think it's a bullish breakout and might even flip your trade to go long. But this isn't a real breakout, it's a fake move designed to collect liquidity. Once the stop losses are swept, the price reverses sharply and drops, moving in the direction you originally expected, but you're no longer in the trade. Market makers don't trade like retail traders. They can't place massive orders all at once because it would disrupt the market. Instead, they spread out their orders over time, creating supply and demand zones, areas where price frequently reacts. If there aren't enough buyers or sellers to fill their orders, market makers manipulate these zones to grab liquidity. Here's how it works. When market makers want to buy, they create a demand zone by placing smaller buy orders, causing price to bounce higher. If they need more sellers, they temporarily push the price below the zone. This triggers stop losses of traders who bought there and attracts new sellers, creating the liquidity market makers need. Once their orders are filled, the price shoots back up. When market makers want to sell, they create a supply zone by gradually placing sell orders, causing price to reject and drop. If they need more buyers, they push the price above the zone. This triggers stop losses of traders who sold there and attracts new buyers, creating liquidity. Once their orders are filled, the price drops sharply. So our strategy is built around two key elements: supply and demand zones and liquidity sweeps. However, before diving into how to trade this setup, it's crucial to ensure that the supply or demand zone you're focusing on is genuinely created by market makers. This distinction is what separates high probability setups from less reliable ones. Over the years, I've developed a set of proven criteria to pinpoint exactly where market makers are operating. Let's break them down step by step. Candle size of the move. Here's what you need to watch for. Large, bold candles all moving in the same direction. These are the footprints of big institutions, clear signs that market makers are active. Freshness of the zone. Here's the golden rule. Stick to zones that have never been tested before. The first test of a zone is where the magic happens. It's the most reliable and offers the highest probability of success. Breakout of structure. Here's what you need to focus on. Look for moves that break significant levels, like previous highs or lows. When you see this, combined with strong momentum, it's a clear sign that market makers are in action. Risk to reward ratio. Here's the deal. Only trade zones that give you at least a 3-to-1 risk to reward ratio. Now that you know the criteria for a quality supply or demand zone, let's move on to the trade setup. The first step is spotting the demand zone. These zones form because big institutions, like banks and hedge funds, can't buy their entire position all at once. It would disrupt the market and push prices too high. Instead, they buy gradually, creating a zone where price repeatedly bounces higher. Here's the critical moment in this strategy. The liquidity sweep. When the price dips below the demand zone, it triggers the stop losses of traders who entered too early. This process generates the liquidity that large institutions need to complete their remaining buy orders. After this sweep, the price often closes back inside the demand zone. This is a clear indication that institutions are ready to push the market higher. This strategy works on all time frames, but it requires proper top-down analysis. If you're trading the 5-minute or 15-minute chart, your higher time frame is the hourly chart. If you're trading the hourly chart, your higher time frame is the daily chart. For the 4-hour chart, use the weekly chart as your higher time frame. And if you trade the daily chart, your higher time frame is the monthly chart. Once you spot a trade on your trading time frame, switch to the higher time frame to ensure your trade plan aligns with the market direction on the higher time frame. Alright, let me show you a real chart example. On the 15-minute chart, you notice a clear supply zone forming. This zone is created because big institutions are gradually placing sell orders, causing prices to drop significantly from that area. Alright, now let's confirm that the supply zone meets all the necessary criteria. This step ensures the zone is valid and worth trading. Candle size of the move. Look at the candles in the drop from the supply zone. They are large and consistent in size, with no hesitation or wicks. This tells us that institutions were actively involved in this move. The candle size confirms strong institutional activity. Freshness of the zone. Now check if the zone has been tested before. It's clear that this supply zone is fresh and untouched, meaning institutions haven't returned to this level yet. The zone is fresh, making it highly reliable. Breakout of structure. Take a look at the market structure. The drop from the supply zone broke a significant previous low on the 15-minute chart. This structural break confirms that institutions are driving the price lower. The breakout of structure validates institutional control. Risk-to-reward ratio. The setup offers a 4-to-1 risk-to-reward ratio, meaning the potential reward is 4 times your risk. The risk-to-reward ratio is excellent and meets our criteria. Without every criterion met, this supply zone is confirmed as a high probability setup. Now, patiently wait for the price to retrace back into the supply zone. As the price approaches, keep an eye out for signs of a liquidity sweep to signal the entry. As the price retraces into the supply zone, something critical happens. It briefly breaks above the zone before closing back inside the zone. This is what we call the liquidity sweep, and it's a vital signal for the trade. Institutions intentionally push the price above the zone to trigger the stop losses of early sellers and trap buyers who think the market is breaking out upwards. This action creates the liquidity they need to fill their remaining sell orders. Once the price closes back inside the supply zone after the liquidity sweep, it signals that institutions have finished gathering liquidity and are ready to push the market lower. This is your green light to prepare for the trade. Now that the liquidity sweep has occurred and the price has closed back inside the supply zone, it's time to check the higher time frame for confirmation. This step ensures that your trade aligns with a broader market structure. On the hourly chart, the market was rejected from a major resistance level and is likely to go down and retest the major support level. This aligns perfectly with our trade setup on the 15-minute chart. However, take a closer look at how the market trapped retail traders. At the major support level, it swept their stop losses before moving up, and at the major resistance level, the market maker swept stop losses placed above the resistance. This highlights that trading is fundamentally a liquidity sweep game. Alright, now let's return to the 15-minute chart. With all confirmations in place, it's time to set up the trade. Place your sell order at the candle that closed back inside the supply zone after the liquidity sweep. This ensures you're entering with institutional backing. Set your stop loss just above the high of the liquidity sweep. This protects you from any unexpected moves while keeping your risk minimal. Target the next demand zone on the 15-minute chart. This is the most logical level where price is likely to bounce. Measure the distance from your entry to the stop loss, and ensure the take profit level provides a minimum 3-to-1 risk-to-reward ratio. Look at what happened next. As expected, the market respected the supply zone and moved directly to our target. The price dropped sharply, hitting the profit target.